All attendees are in listen-only mode.
Hello and welcome to today's webinar from James Cooper Creston about topical tax matters. My name is Margaret Savory and I'm a tax director at James Cooper Creston. We're a firm of accountants and tax advisors and particularly work with a lot of spin-out companies from universities as well as technology companies. Today I'm going to talk about the patent box rules. It is a while since I gave the last webinar on patent box, so this is by way of a refresher and to bring you up to date with the rules and what has happened since my last webinar. Please do feel free to type in or email me with any queries as the webinar progresses. I may not have time to cover them off in the webinar, but I will aim to respond to you directly. This is now the format for the webinar. I have included more detailed slides for completeness, but might skip over them now as I proceed through the webinar. The idea is that the slide deck is there for you to refer to as and when needed. So first of all, let's start with some updates. So current statistics and developments. As you're all probably aware, the patent box was introduced in April 2013 as a complement to the very successful R&D tax credits. The idea was to incentivize companies who had generated IP, namely patents, from their research efforts, and therefore further reward them at the point that they were profitable, because as you know, R&D tax credits is normally, a lot of the benefit is for loss-making companies. So the idea with patent box was to give a reduced rate of tax for when the company was profitable. At the time that the patent box was introduced, many SMEs and their advisors felt that patent box was aimed mainly at the larger entities and the costs of doing patent box could outweigh potential benefits. This slide looks at the uptake of patent box for the most recent years for which statistics are available, which is 2016-17. Incidentally, the 2017-18 statistics are due out in a couple of weeks' time from HMRC, and they do publish them in the public domain. But the key things to note from this slide is that, firstly, the patent box, and it's stating the obvious really, is much less popular to the extent that it's 40 times less popular because R&D has 40,000 claims, whereas patent box only has 1,000 claims. So R&D still continues to be the biggest incentive. But it's not really surprising given that the R&D tax relief applies whether you're loss-making or profit-making. For patent box is really only of benefit when you have profits to be taxed. Another interesting thing to note is the spread between the different sizes of company. Now, whilst only 1/4 of the claimants broadly are classed as large companies, which means more than 250 employees or turnover in excess of 50 million, balance sheet 43 million euros, those 280 odd companies account for more than 95% of the actual patent box tax relief benefit. So it could be that said that the large companies do benefit to an extent a lot more. So at one level we've got 3/4 of the claim going to small and medium-sized entities, but only 4% of the benefit. So maybe there needs to be more done in terms of claiming or raising awareness on the SME community so that more can benefit. One thing that might help, which is not a bit of patent box legislation, but it is a bit of relevant recent legislation, is the change in law regarding goodwill on the acquisition of a business. It's another potential fiscal incentive, in addition to patent box, to have patents or patent your inventions. By way of background, since 2015, it has not been possible to obtain corporate tax relief for the amortization, which is, or depreciation, of goodwill acquired on the purchase of a business through trade and assets. However, that's set to change, or just changed, from April 2019. And what the new rules do is that for goodwill or other similar assets, such as customer lists, relationships, and registered trademarks, if they were acquired by the business on or after the 1st of April 2019, there is an amortisation at a fixed rate of 6.5% will be allowed for tax purposes. However, there is a condition, and the condition is the tax relief for the goodwill or similar asset must be acquired as part of a business purchase that includes what they define in the law as qualifying intellectual property. And broadly, as I've shown there, it's patents and similar rights. Now, those similar rights are things like plant breeders' rights and other rights in areas of science technology where historically they don't patent, but there is some other form of public domain registration. So this is something as well to consider in terms of formally registering your IP, and maybe another tax benefit in addition to Patent Box. And I just introduced that in terms of that's a current recent development. The next slide as well is related to Patent Box, but is not Patent Box. But as I've already mentioned before, Patent Box and R&D go hand in hand. And just to update you on the latest changes to R&D legislation, there's been a lot in the press about this, that new legislation is going to be introduced with effect from the 1st of April 2020, which will potentially cap the amount of cashback a loss-making SME can get back on their R&D relief. And it's going to be capped at 3 times the total PAYE and NIC. So that is quite generous in HMRC's eyes, because it's not just the PAYE on NIC on researchers involved in R&D, it will be the company's total PAYE and NIC bill. And as I say, they'll say there's a cap at 3 times. There are certain key companies, as I've said there, that could be affected, which is a lot of the science spin-outs, because often in the early stages they have very few employees and they subcontract a lot of their R&D either to third parties or back to their founding university. And it also could affect OMBs, owner-managed businesses that are very small, say a husband and wife team, and again they don't pay themselves salaries and maybe they subcontract out the R&D with very low headcount. So HMRC issued a consultation in April or May of this year, and they thought of ways to mitigate for these companies most likely to be affected, that are legitimate R&D companies, but may be affected by the cap. Incidentally, the cap was introduced because of perceived abuse and fraud in the system. So the idea is they only want to pay back to legitimate companies conducting legitimate R&D. So the consultation looked at various ways that they might mitigate this for the legitimate company, considering carry forward of the unused portion of the cap if you have if the cap is applied and you've still got R&D that you could potentially claim cashback on, considering whether you could include other group companies in the total of PAYE and NIC, and considering whether there could be a de minimis amount below which they would automatically give the cash back because it was so small. They also considered things like documenting, improved documentation to prove R&D had taken place. At the present time, all the responses have been submitted for the consultation, which closed at the end of May. We've not had any updates from HMRC. The only thing we definitely know is the cap will be introduced for expenditure from 1 April 2020. But that is R&D and not Patent Box, but I just wanted to introduce it because it is very topical. So let us now, having finished with our current statistics and developments, move on to the rules themselves. So the rules were introduced, as I said, on the 1st of April 2013. However, there was an amendment that was added in the 1st of July 2016. And this amendment came about because of as a result of the OECD base erosion and profit shifting project, and the Patent Box in the UK was looked at as part of Action 5, harmful tax practices. So a modification was introduced from the 1st of July 2016. So there are almost 2 schemes running parallel because we're now in 2019, but everyone will follow the additional step and what are called the new rules from the 1st of July 2021. So what is the UK patent box? As the slide states, the patent box is a reduced rate of corporation tax for profits on worldwide sales of products or income which includes a patent. This is currently 10% compared with the current corporation tax rate of 19% for all other taxable profits. And just note that with effect from April next year, the corporation tax rate is scheduled to come down to 17%. So at one level, you could argue this reduces the benefit of the patent box. HMRC have not indicated that the patent box rate will reduce further to keep the differential the same. So this all sounds fairly straightforward, just a reduced rate of tax. However, there are detailed qualifying conditions which we will look at in the next slide. So there are qualifying conditions relating to the company and to the type of intellectual property and the patents. And as I've alluded to, there was a change in the methodology. It used to be, and in some circumstances still is and will be until July 2021, a 3-step calculation. But when they pronounced on this BEPS project, Base Erosion and Profit Shifting project, an extra step was added in July 2016. So that's called Step 4. So that any company entering into the patent box after 1st of July 2016 or creating new patented products or creating new IP in the form of patents, they would have to add this 4th step. As we shall see, this 4th step involves linking the R&D work undertaken by the company to the patents or the patented products that have been created by that R&D, and that can create some documentation complexity. However, I believe that the good news is that for most simple and smaller companies, this additional step 4 may not be as complex as first appears. This is something you will need to consider in the light of your own company circumstances, but there are ways certainly to cut through the complexity of the patent box. So if we first of all look at the qualifying conditions. Firstly, a qualifying company. So it has to be a company or an entity within the scope of corporation tax in the UK. So typically companies. And the company has to actively elect into the patent box. This is a one-off election that is made by the company. So it's a one-off on a company-wide basis. It is not per patent. And once the election is made, the company remains in the patent box automatically each year. The deadline for the election is 2 years after the accounting period end, so this can give companies time to see things pan out before electing into the patent box, particularly that first election. The key thing to note is you cannot cherry pick which years you'd like to be in the patent box once you've entered into the box. You automatically have to follow it every year. You have to undertake that patent box calculations for better or worse. You are free to come out of the patent box, but once you've come out, you can't re-elect in for another 5 years. So it's about proceeding with caution when you go into the patent box to make sure you will benefit, because basically you will be in it. If you come out, you can't go back in for 5 more years. The qualifying company must own qualifying IP. And what does that mean? It must own or license in patents that are either with the UK or the European Patent Office or one of 13 separately listed EU states. And these are states which the UK authorities feel have a good patent office or process. So this is all public domain information. And what sort of IP can this be? It can be new patents that the company's applied for, or it can be patents that the company has acquired and then further develop. So either developing the technology or developing the products containing the patent. It can also be equivalent rights similar to patents in specialist sectors, as I've mentioned before, such things as plant breeders' rights. Another key question is, at what point, when do you start to own this qualifying IP? For a new patent, this is the priority date of application. However, so that means the whole patent pending period will be included. However, the company will not get the benefit of the patent box calculations until the accounting period when the patent is granted. However, be aware that the company needs to have been elected into the patent box for that first accounting period for which the patent is applied for. If the company has never had a patent before, it may need to elect into the patent box and make the calculation and gather the data for those years, which can be several years until the patent is granted, at which point all that data and calculations will be brought into the tax computation of that accounting period when the patent is granted. However, you needed to have been in the patent box for that year when the patent was applied for. The total look-back period from the date of grant is 6 years. So if your patent process or your patent pending takes longer than 6 years, you won't be able to go beyond 6 years from the date that the patent is granted. The next two slides have a bit more detail on the qualifying ownership conditions. The company must itself undertake qualifying development or another member of the group. However, we just have to be aware that it might either can contribute to the development of the IP or develop the patented item. And this needs to be done by the company itself. And they're very keen that you must have to actively develop at some point in the history of the product or the patent. You can't just acquire a patent and then sell it on or just market a product containing it. One thing I've noted there is watch a change of ownership. There are detailed rules about when you've acquired an IP to continue development immediately after acquisition. So the key thing is it's about developing further your IP and not just passively owning it. This slide reiterates the point that even in groups of company, you need to ensure that the company who owns the patent also has continued to do some development of the patent or product incorporating the patent. Under the pre-2016 rules, it was possible for an IP holding company which did only that to be eligible for the patent box, provided that somewhere else in the group the eligible R&D work was being done. However, because of the need to link R&D to the patents, you may need to revisit the status of an IP holding company if it just holds patents. It may have to start considering whether it should be doing some active development in its own right. So finally, we come on to the 4-step rules of the patent box. Just remember, this is a side calculation. So the result of this patent box calculation is a number that will slot into your corporation tax computation to reduce your tax bill. So here are the 4 steps. And this applies to all the income that is derived from patents in the company. And each year, therefore, the company will need to review its patent portfolio and its IP product portfolio and consider how the patents map to the income. And then for each patented product or suite of products, you will effectively need to work out a mini profit and loss account for that income stream. So first, you take the income from the patented product sales and then match up with the relevant costs. So that really is step 1. You work out the income and turnover from your patents, and that is known as your relevant IP income. Under the pre-2016 rules, you could just work on a proportionate basis for the rest of your costs, so just basically apportion your costs on the relative income to the total income. Anything after 2016 and with effect from 2021, you will have to do the mini profit and loss account for each type of patented product or suite of products, and that was known as streaming. Having got to this mini profit and loss accounts, there's another step called step 2, which is removing the routine profit element. And that's called removal of the routine return. And arguably, the HMRC's view is that you would make a profit on the sale of that product regardless of whether it had a patent or not. And their view is that you would make a 10% markup profit on certain key costs. So they strip that 10% out, because what they're trying to get at is the core element of profit that is derived from the patent only and the IP, rather than just you selling that item anyway. So what you have to do, and this is a mandatory step, you strip out that routine return. What you're left with is what's called the qualifying residual profits. And I've included these bits of jargon here because that is what the legislation and the revenue refer to. So another strip out is step 3, which is where you move the marketing asset return, MIR. And that basically is reducing the amount of profit that may be in the patent box for brand. Again, it's saying we're trying to get to what is the super profit that relates to the patented item only. And finally, step 4 looks at how much in-house R&D you have undertaken on the patents. So this is the new step that was added. So it looks at this relative fraction of what you've done in-house to what you might have subcontracted, either to outsiders or fellow group companies. So if you don't subcontract to other group companies, i.e. because you're not in a group, this step is probably not going to affect you in most situations. And we're now going to take a little look at each step of these mechanical situations in detail, as they are the crux of the patent box. However, just before we look at that, we just need to think about when you can elect into the patent box and what rules you might be following. So here we are at the end of 2019, and we want to consider whether we need step 4 or not, applying this additional R&D fraction. So what are the questions we need to ask? Well, we need to identify which accounting period we're considering. If the accounting period began after the 30th of June 2016 and we're entering into the patent box for the first time, then you are definitely a new entrant and you will have to apply this R&D fraction step 4. We'll talk about the detail later. If you have an accounting period that begins before that date, you have to consider when was the qualifying IP created. So if the qualifying IP was created prior to the 1st of July 2016, then you will stop at step 3. Now, we're now beyond the 2-year deadline for that, so this will really only apply to companies that have already entered into the patent box. But if you have already entered into the patent box, but you created qualifying IP post July 2016, potentially some of that new IP created could follow the new rules. And as we will see, you might have old and new rules happening in this transition period until the 1st of July 2021, when all companies have to apply step 4. And it refers to a phrase there, track and trace. And this is what the legislation and the HMRC guidance refer to, which is where you basically have to map your R&D spend on your patents or patented products to calculate the R&D fraction. So, back to looking at the detail of our steps. Step 1. So what we're trying to get at is what income goes in the patent box. And the key thing is that this is worldwide income going into the company derived from the sales of the product, so long as somewhere in the product there is a patented item. When discussing this in parliamentary committee, the example of a BMW was used, with the only patented item being the windscreen wiper. Yet the worldwide sales of the entire car would come into the patent box calculation. In terms of the heads, there are 5 heads. The last 3 are to do with the patent itself, selling on the patent or damages from patent infringement. Most companies, in my experience, having worked on patent box, is 1 and 2, which is you either sell the product, you've got a patented product, or you've licensed on the manufacturing or the rights to someone else. And those income is what can be brought into the patent box. I also want to just talk a little bit about the second bullet point, which talks about the notional royalty. This is for those circumstances where you do not sell a patented item, but instead have a patented process, or maybe the machine that you use to manufacture your product is patented. The HMRC manual gives some examples, one of which is where the machine you use to manufacture a widget is the thing that's actually patented. The other example is an airline selling tickets, but the pilots of that airline train on a simulator that the company owns, which the company has developed, and that simulator has patents. So you can see selling tickets is not selling a patented item, but you still have developed some IP, own some IP, and arguably that would give you a competitive edge, or for which you might charge a premium. In these circumstances, the notional royalty is a mechanism for you to be able to work out the benefit in financial terms of the ownership of that patent, albeit indirectly, but to bring that amount into the patent box calculation. The legislation talks about transfer pricing principles, which is broadly what you would pay a third party an arm's length price to have access to that patent technology, as if you didn't own it yourself. And therefore that notional royalty calculated amount is what you can bring in as income into the patent box. So, for example, if you couldn't manufacture your widget without your patented machine, arguably you would pay a significant proportion of your profits to have access to that patented machine. That element is what you could then bring into your patent box calculation. Having worked out your income, either through heads 1 to 5 or through a notional royalty calculation, you then need to work out the costs that relate to that income, either directly attributing them to the patented stream, and in cases where it's impossible to directly map the costs, one should apportion on a just and reasonable basis, say a portion on headcount or floor space, depending on what's relevant. In some circumstances, as I've mentioned before, if you were pre-2016 entrant into the patent box, then you can just take the ratio of your patented income to your total income as a simple formula. And there might be, under these new rules, you might have multiple substreams, multiple mini P&Ls for lots of different patented products, patent suites, depending on the complexity of your product portfolio. The next slide looks at a simple example where you might just have a 2-column spreadsheet. So you've got company A, which has some non-patented income and some patented income. And they both have 2 million of sales, so 4 million in total, but the patented item actually is much more profitable, has far fewer costs attributable to it. So what you would do is work out a little mini P&L for both your patented and non-patent items, obviously coming to the total. And then it would be, in this example, the 1/800 of profits that you would then say, those are my patent box profits, I will tax them at a reduced rate of tax. The remainder I'll tax at the higher rate of tax. However, this potentially could be oversimplistic, and the next few slides will look at what has to be deducted from the patent box column as well. So we've only just really achieved step 1 with that example. The next step in our calculation is to strip out the routine return. As I said before, the argument goes that you would have made a profit anyway from selling the said product, with or without the patent. So our HMRC have prescribed that for your admin costs, whatever you sell, you would achieve a 10% markup. And they ask that in this step, the 10% markup on these routine admin costs is stripped out of your patent box calculation. Again, some of this will be on directly attributable costs and some might be on an apportionate basis. As it says there, there are some costs that are not included in the calculation. In particular, all costs relating to R&D should not have a routine added to them because HMRC are intending this to be a complement to R&D, so you don't want the situation of you having spent a lot of money on R&D work and then be penalised because that counts as costs towards your routine return, so it will reduce your patent box. Other things that can be ignored are costs of raw materials and goods purchased for resale, and any license fees on patents. So any of those costs don't form part of this extra strip out of routine return. Then step 3, which was the original end step, is to remove the element of profit that relates to brand. So in the context of our BMW example, that would be why you buy a BMW over a generic car. And again, arguably some of the profit from the sale will be attributed to the brand and not the fact that there are patented elements in the product. And again, we're trying to get to that rate of tax, reduced rate of tax, only applying to the pure element of profit and not brand. Again, this looks at notional calculations based on transfer pricing, and basically, at a simplistic level, you compare what have you spent on marketing against what you think the brand is worth. And this is a big enough brand, you will have to do big transfer pricing studies. If you've spent nothing and the brand is hugely valuable, then arguably you have to strip out further costs from the patent box. However, 2 important things to note. There is a safe harbour. If you're a small startup and basically business to business, this safe harbour allows you to reduce this strip out to nil. Each case is on its own merits, but certainly a small niche startup does not have the marketing profile of the likes of Apple or BMW. Additionally, for smaller claims, if you really want to keep it simple and not do anything, you can just elect to strip out 25% of your profits as being related to brand. But that is when you only have pre the marketing return profits of less than $1 million. However, in most cases, I think there's a strong argument that the brand could be reduced down below 25%. So up until July 2016, that was all that we had to do. And this slide is a useful summary and recap. So basically, under the pre-2016 rules, you go down the left-hand side, and there you can see step 1, step 2, and step 3. And you arrive at this thing called the relevant IP profit. For step 4, we have to do this separate calculation, which is down the right-hand side, and we calculate this thing called the R&D fraction, which we then multiply by the relevant IP profits to arrive at the actual patent box profit that we will put into our tax computation. So the next slide looks at what the R&D fraction is. So the points to note that it is as the lower of 1 and the calculation. So basically, the R&D fraction will never be greater than 1. First of all, let's ask what mischief is this trying to avoid? And what it's trying to avoid is companies in a group subcontracting their R&D out to other group companies. Probably overseas, but not necessarily. It's just to fellow group companies. So that the work developing the patent is not undertaken directly by the company owning the patent. Thus, if you're not in a group and haven't acquired any AP, you know your fraction is going to be 1. So what have we got? On the numerator, the top, we've got the direct in-house costs incurred on R&D and subcontracted to third parties. So it doesn't matter if you subcontract out to third parties. And that times 1.3 is just an uplift there. It's a protection mechanism, so you might have a bit of R&D that you've subcontracted to a fellow group company, but it means that it gives you a buffer, so you potentially still could have an R&D fraction of 1. On the denominator, you have in addition, and this is the thing that can reduce your R&D fraction, costs of acquiring IP. So this could potentially be relevant to university spin-outs when they acquire IP, and the costs of R&D subcontracted to connected parties. These costs are cumulative costs, and the data may be included for up to 20 years. So if you acquire some IP, that's going to remain on the denominator for the next 20 years. Similarly, if you subcontract out. So again, pre-planning is essential. and really watch out if you acquire IP. So key things to be aware of and consider, particularly as this fraction will last for 20 years. But in a lot of cases, if you're a standalone company, your fraction is going to be 1. However, you still need to gather the data. So even though you know that your fraction may come out as 1/1, you still need to do the exercise, even at a high level, of gathering the relevant data. The next couple of slides I'm not going to refer to, but it is further definitions of what is in-house R&D and relevant R&D for patent box purposes. Basically, it mirrors the R&D legislation, so how you will track and trace your R&D to your patents. And moving on, just thinking about tracking and tracing, so this is the mapping of your R&D or your income to the patents. You need to map basically on both the income and expenditure side, as this slide says. So it's important you think about gathering data and how your accounting systems are set up if you think you're going to be in the patent box in the future. So you've got to map the income to the right product and process, and the R&D expenditure as well. And there's a little note about the gathering data. Even though you might not have yet entered into the patent box, they expect you to be starting to gather data. And as it says there, you can let go back 20 years, but they have an expectation that you probably should be mapping from July 2016, if not July 2013 at the earliest. So it's worthwhile thinking about your data gathering. This example slide is just something for you to look at your leisure, but basically is making the point about the potential effect that the R&D fraction could have on what, before this was applied, would have been your patent box profit. So the far left-hand one is where you've got an R&D fraction of 1, and what the patent box profits would have been, and then depending on how you map your R&D to different products and patents, it can reduce the amount of the patent box benefit. I've mentioned it before, there is a right time to enter into the patent box, because once you're in, it's a company-wide election, you have to carry on being in. It's probably generally not a good idea to enter into the patent box when you are loss-making, which is why a lot of spin-outs who are currently loss-making, it's a thing that's on their agenda for the future. However, you should just keep it on your radar in terms of making sure that you satisfy the patent box rules for the future or for any due diligence purposes. The next slide is again there for reference. It just tells you how the patent box benefit is given. It's as a deduction in the adjustments of profits in the corporation tax return. So we've looked at the detail of the patent box calculation, and that should be a refresher for you, as this legislation has been around for a few years now. What I just want to talk about now is to think about this transition period that we're currently in. So we're going to have a few looks at transition and how things might get complicated. So this slide tries to show you where potentially you might have to data gather and give different treatments for different products. Up until 30th of June 2016, if you entered into the box and had a patented item before that date, you would be under what were known as the old rules, or you stopped at step 3. You can carry on, if that's all you're doing, you can carry on following those rules until 2021, when after that date you will have to bring in this R&D fraction. And those are known as the grandfathered rules, and you can carry on. If, however, you perhaps entered into the box beforehand, or you're a brand new entrant, you will have to follow the lower route, because that's after the 31st of June, in which case you will use the new rules for that. So you can imagine a company that entered into the patent box before 2016 with product A, they're following the old rules, no R&D fraction required for that product, but if they've developed a new patented product, they will need to follow the new rules for that. So you can have two separate patent box calculations going on at the same time. So this can introduce a level of complexity. After the 30th of June 2021, everyone will be bringing in patent box rules. So potentially, in the transition period up until July 2021, there are potentially several permutations, and you may have to decide whether the patent or product development undertaken falls into the old or new rules. So if we work from this diagram from left to right, we've got two companies, and they're developing different products, and we talk about when the patent qualified, whether before or after July 2016, and when they entered into the accounting period, when they entered into the box. So product one, company one had patent one, product one, and they stopped at step 3 because they entered into the old rules. And they can carry on using those rules until July 2021. Company 2 entered into the patent box after the 1st of July, and so is counted as a new entrant and therefore follows the new rules, introducing the R&D fraction. If company 1, so it's already in the patent box, then starts to develop patent 3 and product 3, but that happened post 1st of July, it will have to follow the new rules for that product, although it will carry on with product 1 just using the old rules. If company 1 carries on and develops product 4, but it's just an improvement on product 1, so it's still sort of the same product, well, it depends. You could stop, it's probably not changing the product 1 at all in any way, then you could probably carry on following the old rules. But if then they have patent 5, and that really upgrades product 1, so it's almost a new version of product 1, are you going to follow the new rules or the old rules? Well, it depends. And HMRC have thought about this and gives you 2 alternative methodologies for calculating. So they talk about products containing both old and new IP, and you need to test this every year or every time you add new IP to decide whether I'm going to carry on following the old rules or the new rules. And the legislation deals with 2 different methods. It's either the core value, which is a more what I call philosophical, what value have I added to the product, or the more pragmatic physical count up the number of patents in each. And then in each case, depending on the sort of percentages or the balance, you'll decide whether you fall into the new rules, so broadly an 80-20 rule. So if you have more than 80% new rights, you'll be new rules, more than 80% old rights, you'll be entirely old, and it's sort of all or nothing. And then the bit in the middle, apportion some middle way. So an additional complexity for this transition period. But again, if you're a single patent, single product company, then you really don't need to worry about this. It's only if you start adding to or developing new products in the period. The next slide, I'm not going to mention it, but again, it's by way of reference. It gives you the link to the HMRC manual where they give some details of a very specific example in the transition period. And the next slide, I'm mindful of the time, there's just some other aspects of the new rules which may be relevant depending on your circumstances. So there are special rules in the legislation for transfers of trade. If you're really small, there is what's called a tick-the-box small claims treatment, where you can make what's called a global streaming election, so it's just regarded as 2 streams, a notional royalty election, and again, I've already mentioned the marketing asset return. So there are some simplifications. However, caveated, you may not get the best result with those simplifications. There are special rules for cost-sharing arrangements when you perhaps jointly do the R&D for a shared patent. And there is this thing called the rebuttable presumption. If your actual physical numbers don't give you the right result, doesn't reflect the reality of what you think, you can write to the HMRC and say, well, actually, my fraction should be something different. So there are added steps and mechanisms, should you need them, in the legislation. Just to finish off, I would just like to give you a few practical thoughts from my experiences of doing R&D and patent box for clients. The key thing is to make sure, even if you're not in the patent box now, when you're dealing with setting up accounting systems or new accounting systems in particular, you have the capacity to collect the data that you need to either map your income or your expenditure across to these patents or patented products. So think about how your account system gathers and maps the data. That is going to be increasingly important once you get into the patent box. And you need to go back in time as well, as I've alluded to. So even if you're not actually tracking or in the patent box, think about how you group your patents or group your products. The HMRC guidance is deliberately vague, I would say, but they allow you, depending on your accounting treatment and how your product calculations and accounting work, so as to not create additional unnecessary work for you. As I've said before, my experience of doing patent box is lots of companies are unaffected by this R&D fraction. You need to gather some data, but you'll often end up with 1/1. And finally, one to be aware of, you must make sure you have some R&D activity in the period, because HMRC confirmed to me that although it's not mathematically correct, 0/0 equals 0. So if you're sitting on a very old patent that's been very useful, generally you did R&D way back when, and now you're just generating income from it. If you've got no R&D conducted post 2013 at the earliest, or 2016, then potentially you might have 0/0 and your patent box profits could be nil if you enter in as a new agent. A couple more thoughts. Groups, we talked about the fact that the IP holding company might not work in a patent box context, so make sure you know who does what. Another thing to consider is if you're in a group and you are subcontracting out, this is the key thing that affects your R&D fraction, consider your supply chain. Maybe you should subcontract directly to a third party, which doesn't have the same effect on your R&D fraction, rather than going via your group company intermediary. With transactions, do your due diligence, beware of any IP acquisitions, as that value of the IP, the patent acquired, does go into the patent box fraction as a denominator and could affect your fraction for up to 20 years. And also spin outs, think about what value you're acquiring when you acquire that. So in conclusion, and in summary, this has been a whistle-stop tour through some 40-odd pages of legislation and 40-odd pages of extra legislation when the new rules came out, and several hundred pages of HMRC guidance. I've tried to give you a flavour of the patent box, some areas of complexity. However, I firmly believe, and I've seen it in action, for the right client, where you perhaps have simple 1 or 2 patents and products, where you conduct your in-house R&D all yourself, you don't subcontract to any group companies, you're a standalone company, and you're profitable, it can be a very straightforward and relatively mechanistic way of reducing your corporation tax bill. If you need assistance, this is really for reference only. HMRC are always happy to talk. They have an email address that you can put your technical query to. They're always happy to have conversations on technical aspects if there are areas of uncertainty, but they have very detailed guidance in the manuals, and I've given you where to look for the guidance, which is the Corporate Intangible Research and Development Manual. It's all public domain. You can see it on the government website. With that, without further ado, these are my contact details. Please contact me if you have any queries. We're only too happy to do patent box calculations or make patent box claims for you. We have already done several very successfully. Thank you very much for listening, and enjoy the rest of your day.